Have you ever looked at a company, maybe Google or Tesla, and just wondered, what is that share really worth? Or even, that house you're thinking of buying? For a lot of us, figuring out value seems, well, really daunting.
Yeah, like it's some secret club for finance gurus, right?
Exactly. But what if it wasn't? Today, we're taking a deep dive into insights from The Little Book of Valuation by Aswath Damodaran.
Damodaran, the dean of valuation.
That's him. And his whole goal with this book, part of that little book series, is basically to strip away the mystique. He wants to make valuation accessible so investors like you can make, well, smarter judgments.
Yeah, and what's great is he's not just defining terms. He really challenges that whole black box idea around valuation. He argues pretty convincingly, I think, that anyone willing to put in the time can figure this stuff out.
Okay, so the core message is empowerment. It's not just for the pros.
Exactly. The aim is to equip you to look at those analyst reports, those value judgments, and decide for yourself if they actually hold water.
I like that, making it accessible. But where do you even start? What are the essential tools Damodaran says we need?
Right, he calls them the power tools. And the first one is absolutely fundamental, the time value of money.
Okay.
Think about it simply. $100 today or $100 in a year.
Today, definitely.
Right. That instinct, that is valuation, basically. $1 now is worth more than $1 later. Why? Well, you'd rather use it now, plus inflation eats away at its value, and, there's always a risk you might not get that future dollar. So this idea, it's called discounting. It just lets you compare money across different time periods, makes it apples to apples.
So it reveals the real value today of something you expect to get later, like profits from a business.
Yeah. Precisely. Like figuring out what that future gold mine is actually worth in your pocket right now.
Okay, that makes a lot of sense. It stops you getting carried away by big future numbers. What's
Yeah.
next in the toolkit?
Then you got accounting basics. But maybe not how you usually think of accounting.
Oh, how so?
Well, most balance sheets just look backward, right? What things cost. Damodaran pushes for a forward-looking financial balance sheet. It's less about historical cost and more about what assets are worth today and, crucially, their potential for future growth. Assets in place versus growth assets.
So shifting focus from just the past to the present value and future potential.
Exactly. It forces you to think about where the real value creation is going to come from. It's a different way of framing things.
Okay, time value of money, a forward-looking view of accounting. What's the third power tool?
Statistics. Don't let the words scare you. It's just about making sense of all the data out there.
Right.
Simple concepts, really, like correlation, how two things move together. Think interest rates and inflation, maybe.
Okay.
Or even a basic regression that can help you predict one thing based on another. And you might see something called R squared. That just tells you how much of the change in one thing seems to be explained by the change in another. It helps you see relationships in the noise.
Got it. So tools to handle time, assess current and future value, and make sense of data. Once we have these tools, how does Damodaran suggest we actually do the valuation? Is there one main way?
Well, he lays out two core approaches, two main paths you can take. The first is what he calls intrinsic valuation.
Intrinsic, so the value from within the company itself.
Exactly. The question here is, based on this company's cash flows, its growth prospects, and its risk, is it under or overvalued right now? You do this by forecasting all the cash you expect the company to generate from its current operations and future growth, and then you discount those cash flows back to today using a rate that reflects the risk involved.
Yeah, it sounds detailed.
It is. You can value the whole firm that's looking at free cash flow to firm or FCFF or just the equity part for shareholders using free cash flow to equity, FCFE. It really hinges on your estimates for cash flows, growth, how much financing costs, and like a final value for the company way down the road. He uses examples like Zomato, Airbnb to show how it works.
Right. Using real companies makes it click. But that sounds like it involves a lot of assumptions about the future.
It absolutely does. And that's a key point. Intrinsic valuation requires discipline. You're essentially building a story with numbers, and you need solid grounding for that story.
So what's the alternative if you're maybe less comfortable forecasting 10 years out?
That brings us to the second approach, relative valuation. Or you could almost call it pricing.
Relative, so comparing it to others.
Precisely. The question shifts. Now it's, is this company cheap or expensive compared to how the market is pricing similar companies?
Like checking house prices on the same street.
Exactly like that. You're looking at comparable assets. So maybe comparing the price to earnings, the PE ratios of tech companies like Cisco, Apple, Microsoft. But crucially, every multiple, whether it's PE or price to sales or whatever, is driven by the same fundamentals: risk, growth, and cash flow potential.
So you can't just compare PEs blindly.
No, you need context. For example, you might adjust the PE ratio for expected growth that gives you the PEG ratio. Or use statistics, like regression, to control for several differences at once when comparing companies.
Okay, so intrinsic looks inward at the company's specifics, relative looks outward at market comparisons.
That's a great way to put it. Two different lenses to estimate value.
So wrapping this up, it feels like whether you go intrinsic or relative, it all comes back to the same core ingredients.
Cash flows, growth, and risk. Those are the three legs of the stool for any valuation.
And actually profiting from your valuation.
Well, that depends, doesn't it? On how good your analysis is, sure, but also on how the market eventually reacts. And, let's be honest, a little bit of luck never hurts. Damodaran challenges you, really. Be a storyteller who can quantify, or be a number cruncher who can build a narrative. Bridge that gap.
It's a powerful idea. So the challenge for you listening is, how will you connect your stories about investments with the actual numbers? And maybe, just maybe, what hidden gems, what undervalued companies might you find if you start applying these tools with a bit more curiosity? And always remembering diversification.